Well, the volatility hasn't gone away, and either has tensions between Russia and Ukraine. We're going to continue our ongoing discussion, markets, geopolitical risk. We're going to bring on Andy Busch, a political economist, to help delve through all of this. I'm Andy Gersher, and this is Gains. So as I mentioned in the lead, we're bringing on Andrew Busch, former Chief Markets Intelligence Officer at the Commodity Futures Trading Commission and economist at andrewbusch.com. Andy, always great to have you on the Gains podcast. It's been about maybe 6 weeks since we last had you on. Wow, how things have changed. A lot has happened since then. Markets have gotten really volatile, and things in Russia and Ukraine have heated up in a big way. What's your take on the things that have popped up since we last spoke?
Wow. I mean, it seems like years ago, doesn't it? I mean, there has been so much going on. Let's start with the Federal Reserve. Obviously, that's one of the biggest things that's been going on because of the CPI and the PPI numbers that we've had out recently, much higher than expected. The inflation looks to be endemic. It's not just in automobiles or food or energy. It's spreading out to other parts of the economy. When you think about commodities overall, there's just not enough supply. There's not enough supply of energy. There's not enough supply of nat gas, of oil. So we know those prices are going to stay high. And it generates the uncertainty over the Federal Reserve of what they're going to do, how far they're going to raise interest rates. Right now, I think the market's pricing in about 150 basis points of rate hikes this year. But the big question is, what do they do with their balance sheet? And just as a reminder to listeners, the last time the Fed engaged in both raising rates and quantitative tightening was back in 2018, and it created all sorts of volatility in the financial markets. The threat of that is occurring right now. And then you can overlay that with what's happening in Russia, and things are pretty messy. Yeah,
I wonder if the market sell-off has less to do with Russia and Ukraine and more to do with Fed policy and inflation. I kind of have a sense that it would be there regardless if this Russia-Ukraine thing was going on in the background.
Yeah, I think you're spot on with that, Gersh. That is the driver, right? So we're creating a volatile interest rate environment because of what the Fed's going to do, and because they're so far behind the curve. The Fed knew about this problem with inflation last year and chose not to deal with it, or at least mistakenly said it was going to be transitory. And now we realize that obviously was a mistake, and now they have to run to catch up, which is the classic Fed mistake that they make. The good news is that we're going to see them be very thoughtful about this. They're going to telegraph it as best they can, but it's still going through the process. And the real problem is when you think about inflation, and I mentioned commodities just a minute ago, the prices have not risen high enough, fast enough yet to really destroy demand enough to have prices come down. And there's not enough supply. So you haven't destroyed demand. The demand is still there. The supply is not there. Oil is in severe what we call backwardation, meaning the spot price is way, way, way above where the forward or future price is. And that just tells you everything you need to know, that short term, there's just not enough of these basic raw materials out there to meet the demand. So that's going to continue for some time into 2022. My guess is we'll get to 105 oil in a heartbeat as soon as Russia does invade Ukraine, and it looks like they're about to do it.
To the oil thing, the supplies are tight and economies haven't even fully opened yet, which a lot of us anticipate, with us living with COVID and learning how to deal with it as economies open up, and we're already in a tight supply. Just think as the demand increases as well. It begs to make the point, why is the Fed gotten so behind this? And I'm surprised they haven't moved on it already. They should hit us right away with a 50 basis points and get aggressive on this now. I mean, anybody who knows anything about Fed policy, it's about those initial moves to set the trajectory of where things are going. I mean, your thoughts on that?
Yeah, they're way behind. I mean, they knew they had a problem with this last year, but I think, if you look back historically, over two other, like what I would call commodity super cycles, back in 1968, 72, and then in 2002, 4, there was a real focus on the lower income to middle income people as far as getting money to them, war on poverty. And then, of course, 2004, when China joined the WTO, they actually joined in 2002, but then about 400 million Chinese became part of, they moved from poverty into middle income. And so it's commodities are demand driven. They're not financial flow driven like equities, right? So there's a level of demand that you get from lower income and middle income workers that overwhelms anybody and anything that would happen at the upper income levels. So they're the people who spend the most money on oil and gasoline, food, and so on. And so as the United States and the rest of the world pumped a lot of money into the economy, and it's specifically focused on getting dollars or money into people's hands, lower income, middle income workers, there was a focus on income inequality to make sure that those people who had not gotten money in the past were taken care of. Well, when you do that, you create all sorts of demand for those commodities. And the supplies, like I would say, if we had, let's just throw out a number. If you had $500 billion worth of CapEx over the last 2 years in commodities, basically $499 billion of that was on, climate change. None of it was on digging stuff up out of the ground, drilling wells and so on. So we're way behind the curve as far as producing these commodities. And the Fed really has buried its head in the sand and really focused on what they call inclusive unemployment, which means they want to broaden their definition out of unemployment to make sure that they're including all of the low income, middle income workers, especially those of color that had missed out. So they want to make sure those people are taken care of. And when you do that, you keep your foot on the gas for a lot longer. And because of that, eventually you end up hurting those people, because when you create inflation, they're the ones who are hurt the most. So
right.
it's a strange world, Andy.
It hits them at food and energy.
Yeah. And housing.
And housing, yes. Just back to the energy aspect of this as well, which is a component to the Russia-Ukraine thing, really shot ourselves in the foot on the energy front over the last 9 months. Just this pullback of domestic production. It's hurt us, and it's led to us having to go to other places. The moves that we've made in the energy space has really shot us and the rest of the world in the foot. That's a big problem. Then meanwhile, you have the Fed having to deal with inflation, and then this all comes with the backdrop of Ukraine and Russia. It feels like a big mess here. So all that being said, and then we also have Russia's in staging areas, okay? So they're going to either have to move into Ukraine or back off. You can't sit in these staging areas for indefinite amount of time. So it looks like Russia's invasion of Ukraine is imminent. My sources say that this is going down. What's the play here? How do you deal with this mess to kind of keep your finances safe?
Yeah, I mean, the first thing that people do is run for the exits, right? So we saw that exactly today with, the S&P down 2%. NASDAQ getting hit, the growth stocks getting hurt the most. Where you can park your money in is, the typical safe plays, which is U.S. Treasury. So we saw those rally. The 2-year was over 203. Now it's down to 197. So we saw that on the 10-year. You saw people moving into utility stocks. So we know that's another play. Moving to cash is another way of doing it. And so we're going to have to see how this plays out. I mean, when you have an event like a war, it's been a while since, it's been since like World War II, since we've had Russian troops move physically on the ground as opposed to what happened in Crimea. And so when you start to extrapolate back off of that, why does that matter for people here in the United States? It matters because it's a small jump from the Ukraine, which had been kind of a buffer to the Baltic states, to Hungary, to Czechoslovakia, and to obviously Europe. So we don't know how far Putin wants to go with this and what the repercussions are going to be. And that's the thing that we don't know. Will there be cyber warfare that could get outside of Russia and the Ukraine, like Stuxnet did with Israel and Iran? Are there going to be sanctions that are going to hurt the flow of technology? Are there going to be sanctions that hurt Russia and China at the same time? These are things we don't know. I mean, the Europeans and the U.S. have been putting out a lot of rhetoric about what they're going to do, a lot of economic sanctions things, but it's rhetoric until they actually have to do something when and if Russia invades. So there's a lot of unknowns. Again, just to come back full circle, when there's uncertainty in the markets, typically people pull money off the table when it comes to risky assets.
So you're a political economist.
Right.
As
I'm an economic futurist, Andy. That's what I am, an economic futurist.
There you go. Even better. But if Russia doesn't move in here, I kind of sense that Putin kind of likes the attention. Nobody's talked about Russia, or nobody was talking about Russia 6 months ago. You have world leader after world leader meeting with Putin. We've been seeing it all week. And I often wonder if for him, it's, you're getting a little attention, you're using this as a negotiating power. What's your take from a political aspect here?
I think, of course, he would like that, but really, Putin wants to put the band back together. He's trying to reclaim Mother Russia, or Mother Soviet Union, I should say. And that's been it appears to be that's been his game plan all along. I mean, he wants the Ukraine, and I don't know there's anything that we could do, meaning all of the nations, to stop him if he rolls in there. We can make it extraordinarily expensive. And there's even talk of shutting down SWIFT payments for the Russian banks. I don't think that's going to happen, because that would be an extreme measure it would really hurt Russia in a way that they would not likely recover, and they would probably become more volatile. So what we want to do is we want to have Putin come back to the negotiating table and stop what he's doing, and get him to understand that these type of military actions will be very expensive for him personally. One of the things the United States has is they know pretty much where all of his wealth is and where it's all stashed and what parts of the world. So why not, personally sanction him, hold on to his assets, and start there? That would be a fun thing to see how that plays out. Putin may like being held in higher esteem to the Russian people. That would be a good thing for him, considering that their living standards have been going down. They dealt with COVID very, very poorly. They dealt with HIV even worse. So they've got a lot of health issues there. So if this is something that maybe internally there's something that we don't know that's going on that's weakening his position, and this is a move to strengthen himself through the conflict, that would be an interesting theory. I think that would be fun to find out.
Do you see him going all the way to Kiev, or picking up some maybe Ukrainian regions that are more Russian-leaning?
It's hard to say at this point. To take Kiev, it's a mess when you get into a major city to try to take it over militarily. I mean, resistance to that is fierce. So the Russians better think very strongly about what they want to do, because they will meet strong resistance in major cities.
Oh, you know it. Door to door in cities? Yeah. Oh, that's, for a military, that's god awful to have to contend with.
Yeah, and it really turns the people against you, which I don't know how they're, the part of the Ukraine that's close to the Russian border, or the closest, Yes, there have been Russian speakers there. They have been unhappy. There's rebels there, Russian rebels. So we know that is part of it exists out there. The closer you get towards Western Europe, I don't think it's the same case. I'm not an expert in that.
No, not at all. That's a big point. As soon as you get to Kiev and then towards, they've gotten a little more taste of Europe, of Western Europe, it is just the opposite. It leans toward the NATO nations. It's very complicated, and it's hard to get a sense on what people are feeling on the ground. But it's a lot easier if Russia moved in and took some areas that are maybe a larger population that's pro-Russian. It'll be.
I just want to circle this back to the financial markets because you asked me what does one do? Well, if you're aggressive, you can sell and then you can look to buy lower, but you could also buy commodities and you can buy energy because that is going to be a problem. And you're going to see energy prices spike on this, or have seen it to some extent in anticipation of it. But that's where you could hurt Russia the most. And I don't know. I'm very circumspect that Germany will stand up to Russia because it's a little bit of mutual assured destruction. If Germany would cut off the flow of natural gas to that country, it would hurt. Yeah. It would hurt the Russians, but it would really hurt them significantly.
That's why Germany's the X factor in this. There's a lot to it. Including the pipeline and energy, and part of it's how Germany mismanaged their energy program, and now they're kind of put in a spot. Plus, they've always had a history of more apt to work with Russia than some other European nations. So Germany really is the big X factor there. So let's hold the conversation right here for a second. Hey, be sure to subscribe, follow, and leave us a 5-star review on Apple Podcasts. And then, as always, subscribe and turn on those notifications so you know when a new episode drops. We drop Gains episodes on Tuesdays and Thursdays. All right, we're going to continue our conversation with Andy Busch right on the other side of the break. All right, we're back with Andrew Busch, former Chief Markets Intelligence Officer at the Commodity Futures Trading Commission and economist at andrewbusch.com. I think, Andy, one of the key points I want to make here is military incidents like this don't have a long-term impact on the U.S. economy or U.S. financial markets. So that's an important point to make here. We often don't see a real long-term impact to these type of events.
Yeah, this is short-term trading stuff. If you're an investor, which is vastly different from short-term trading, having been a currency trader for a large part of my career, I can tell you those two things are very, very different. I think you have to look at situations like what we have with the instability with the Fed, that the Federal Reserve is creating through monetary policy, and then the instability that's occurring in Russia. I think what's happening in Russia is emblematic of how an event can have an outsized effect on the financial markets because we're in a situation of which the Fed's already creating the uncertainty and already creating the instability. So anything that comes along exacerbates it. So that's the environment we're in right now. What does that mean for investors? Well, it could mean that you want to take some money off the table, for sure. You could try to buy some stuff that's a little bit lower. But I would say this, we're going to be volatile. It's great for trading. It's not great for investing per se, but it doesn't mean that we can't continue to see stocks appreciate in value going forward, even with higher interest rates in an unstable world. I think I don't want to put a date on it, but I'd say we're 3 to 5 years from a major recession in the United States because there's still so much money flowing from the federal government into the economy. And if you think about it, I mean, just overall, interest rates are still darn low, Andy. I mean, it's not like they're zooming out of control. I mean, yes, they're up a little bit, but compared to where we were in 2015, I mean, really? I mean, this is still a borrower's paradise in the sense of interest rates are relatively low to where we've been historically.
All right, so we always talk about, you're a futurist, and we talk about the, things down the road long term. So if markets get beat up a little bit, there's going to be a bunch of companies, probably the high flyers that we often talk about, they're going to get roughed up. Okay? So there may be an opportunity to get in some really, really, really good companies that I know you believe in and technologies that I know you believe in long term. Do you take these type of events to, bottom fish or get a good deal on some of the companies? And what are those areas that you would be looking at?
Yeah, I think you can, but I want everybody to be pretty patient when it comes to technology because it's had such a ridiculous run up and the PEs are just so out of control. We're now starting to get those to fall back to earth. All one has to do is look at Cathie Wood, who was on CNBC today, kind of pleading her case that her companies that she's invested in are still great investments and that they're undervalued, which is kind of laughable considering how far they've run up in value. But I still like, as you know, I like a lot of different areas on tech. I like anything to do with electric vehicles. I like anything to do with autonomous vehicles. I like a lot of stuff in space. The space industry is going to soon have a major jolt to it. We had Elon Musk come out with their Starship. If you have not seen what this thing is and what it means for the space sector, I beg you to start taking a look at this because it's, I hate to say game changer, but the fact that it's cheap, reusable, and really, really big means you can get a ton more stuff up in space fast. So that is a sector I really like. And I've said that before. If we're looking further out, like why do I think, 3 to 5 years down the road, we're going to have a nasty recession? Well, I think some of that has to do with what's going on in the U.S. government, and that has to do with the social services programs that are about to run out of money and go bankrupt. And why is that important? Because that means the U.S. government actually has to borrow more money and issue more debt to pay for Social Security or pay for name your, disability benefits, Social Security disability. I mean, Medicare. Those are the things that are running out of money, these trust funds, and that will change the dynamic of issuance out of the Treasury, which means more supply means lower price, higher yields. That's where I think the U.S. can really get tripped up in about 3 to 4 years' time.
To pick up, though, the point that you made earlier, which is really important, I think, yes, a lot of these high flyers have come off a lot. I mean, we saw Meta, a.k.a. Facebook.
Yeah.
I know a lot of people who, when they had that initial decline, they got hit like 20% plus.
Sure.
It's even down from there. You're looking at Meta at 200. So that kind of speaks where you see these drops. That doesn't mean that there isn't more to go. Another one that kind of caught my eye that was just recently was Roblox, which was down. Oh, yeah. Yeah, like 20% in a very short amount of time after earnings. There's people fishing around there. And I mean, that's barely popped up at all. So just because tech is selling off and it looks cheaper compared to what it was even a couple days ago, there may be more room to go as well. And you kind of spoke to that.
As an investor myself, like what I try to do is come up with an overall game plan of what I want exposure to. And then I try to say to myself, okay, like how much money do I have dedicated to that particular sector? And then how do I break it down for the companies within that sector? And so what I try to do is not get, too freaked out by after I bought some and then it drops a lot, it makes me a little hesitant. But what I try to do is go, okay, it's this date per month or this time in the quarter where I have a little flexibility of when I want to buy, but I got to put some money to work. This is when I'm going to do it. So I try to be consistent and not miss out. I've made mistakes as an investor. There's times where I've held off buying something in a quarter, and of course, that was the worst thing to do because it turned around and went up. I will tell you one of the hardest things I've ever had to do recently was I had a block of money, a block of cash that I know I wanted to put to work. And one of the hardest things you do is when the world is selling off to buy, step in and buy. And I'm talking about March of 2020 and April of 2020. That was, I've traded a long time, and it's stepping in buy when the world was falling apart. That was pretty tough to do, I got to say.
One of the smartest things you could have done as well, or throughout probably your entire career.
But I got to tell you, when you're buying and it's down 15% and it goes down 20%, you don't feel too smart. And then you buy more and it goes down 25%, you feel really stupid. But you have to stick to the game plan. And that's what I implore people to do. When I was a currency trader, that's what I excelled at. When I got into positions, when I bought millions of dollars worth of currencies, I was like, okay, I'm buying at 20. If this thing goes to 90 on the downside, I'm out. If it goes to 50 on the upside, I'll cut out half and then ride it and we'll see where it goes. That's what you have to have. You have to have that discipline to be able to do those things. Whether you're a day trader, a longer-term trader, or whether you're an investor, investors have longer time horizons. So that's what I would say. If you want exposure to these companies and you believe in them in the long term, don't be dissuaded by the the recent drops in these prices, but just realize, is buying now part of your game plan? Because if it wasn't, then you really have to be careful about stepping in at this point, because you got to model, you got to go, okay, I'm buying when it's dropping down 20%. If it goes down 40%, I'm going to buy another, chunk there. If it goes down 60%, then I'm out. You got to have those kind of parameters in there.
Well, and that speaks to one other thing I wanted to bring up real quick. A lot of, I think the Gains listeners are probably rather new to the market. You and I have been in this for a very, very long time. Looking back at, 2008-ish. There is a time, Citi really comes to mind. Citigroup was 50. And when it dropped to 25, I'm like, wow, Citi, that's going to be around forever. I'm going to load up. And then when it dropped to like 10, I'm like, oh my gosh. And up until that, years and years and years, that always works, especially with pretty decent companies. Citi's still around. It went down to 5, and I'm like, oh. And the thing is, since then, they even had a reverse split years and years later. I got crushed, and it's never come close to coming back. And, Citi still exists. So there are times when you can just keep going and going and going, and even as it drops. Explain that real quick. You've talked about being a currency trader and, using that discipline on a day-to-day basis or our minute-to-minute basis, as a day trader. But when, as an investor, you're still using the same concept, but explain how you handle that and you minimize getting clobbered when things really, really turn, that, once or twice in every 20 years event.
Yeah, it's super hard to time the markets. If you're a day trader, great. Keep doing that. Do whatever. If you're trading a little bit longer term than that, it becomes challenging to time markets. Let's just pick an individual stock. Like an individual stock, you can, do your homework on it. You look at their revenues. You look at what the company's business plan is. You read the annual report and the quarterlies. And you feel really good about it. Okay, great. You go in and buy it, and then all of a sudden, there is a big shift in what the company is doing. I'm going to use Facebook as an example. So they had reached, a pretty significant peak point with the number of users that were on Facebook, and they were market dominant for a number of years, just crushed it. All of a sudden, they changed their name to Meta, and they go, supposedly all in on the metaverse. Well, that's really interesting. But is that why you bought the stock, 5 years ago? I'm pretty sure not. And it's pretty rare that you can get a leader that you believe in. Let's put Elon Musk in a special little place because there's so few people like him that decides to change the entire direction of the company per se into a new area that's completely untested. Well, that's when you have to say, okay, look, when the stock dropped 20% and it missed on its earnings, there's something going on here that either I don't understand or they've really changed their business model that is not why I bought the company in the first place. I got to get out of this. Those are good things to do as far as an investor goes. You can change your mind on these things. It's important to really take a look at what's going on. Now, there's other times where, and I'll use Volkswagen as an example, where they had the whole CO2 scandal, right? And Volkswagen is a massive company. It's a really big auto manufacturer out of Germany. Now, when they had their scandal of the CO2 coming out of the tailpipes, the stock got hit down pretty hard. But, when you see something like that, you go, okay, yes, management's a problem. They're going to get fined. But really, is this going to change their business model? Are they all of a sudden going to be a pariah and no one's going to buy the car? I don't think so. And I think they'll come back and I think they'll do quite well. That's how you kind of have to walk yourself through it. I didn't know it at the time, but that's what I was thinking when I was looking at Volkswagen going through this. They had an event. It hammered the stock, but then you have to think, okay, after the stock goes down, what's really changed here? And the fact was that nothing had really changed. They had some bad actors. Those people eventually got arrested. They paid a hefty fine, but the business stayed viable. And those are just two examples of where you could own a company, you could get smoked on it, like when it drops. But there are two very, very different reasons for why that company stock price went down. And you just have to understand that those are different situations and be prepared to take advantage of one that makes sense. It's an ongoing concern. They're going to continue to build cars versus Meta, which is still going to make a lot of money, but they're changing their business model to a very untested model. You really have to believe in Mark Zuckerberg to buy the whole metaverse right now. I mean, there's reasons for it. I get it. But how many years away are this from where Meta can actually generate the profits it did as Facebook? I would say a long time. So, that's what you're dealing with on a short-term basis when you're looking at a stock that had fallen significantly. It could fall additional to it because it's changed its business model.
Well, and they got caught up in, right when they announced the Meta thing. That was almost peak cryptocurrency. That was right around the time when crypto was at all-time highs.
Like 64,000.
Yeah. And NFTs are running hot, and everybody's announcing how they're, Ralph Lauren's got NFTs and they're entering, and it just seemed like there was so much hype just built into that move. As we wrap up the Gains podcast today, and I know there's just a lot going on, and it's hard to really get clarity until we see a couple things happen here as far as, your next move. And I mean, there really is a lot of uncertainty. So what's your parting shots for today's Gains podcast?
Yeah, I mean, stay the course. I know that's corny. I know every investment manager says that to you, but what they're trying to get you to do is not, sell the lows and buy the highs to get back in. That's what nobody wants you to do that. So try to be anticipatory in what you're doing. If you think the Russian situation is going to cause a lot more problems and is not going away anytime soon when it comes to energy, well, you should be buying energy. That's where the play is, and you should be buying energy companies because of that. A lot of these stocks were beaten down anyway because of this whole shift towards renewables. But and probably selling Germany. That would probably be an interesting play too. But that's the parting shot. It's like, when you see things start to develop, make a game plan before the event occurs, so that when the event does occur, you're either positioned for it or you're waiting for something to happen where you're going like, I want exposure as this market sells off. I'm going to buy more when it goes down. So just have a game plan. Just don't be reacting to the headlines. That's my parting shot.
Do you ever trade the headlines? I didn't you write a book almost that had something to like trading the headlines or something? Maybe a million years ago. I
did.
You did?
Back in 2007, I wrote a book. It's not great prose, ladies and gentlemen, but the concepts are pretty good. It was called World Event Trading.
Yes. I did read that, by the way.
It gives you a playbook. It gives you a playbook for how events in the past and how they played out in the financial markets, which sectors got hit, like during a political scandal or war, as an example. Or, believe it or not, Andy, the first 5 chapters of the book are on infectious disease outbreak and their impact on the economy and markets. So that book came out in 2007. Nobody read it because that was the global financial crisis, right? But the ideas were pretty sound.
Well, hey, I read it. I read it, though. World Event Trading, How to Analyze and Profit from Today's Headlines. I have a copy.
Right.
I have a huge book collection. And
you and my mom are probably the only people that bought it.
In fact, I should have you, next time we get together, maybe I'll have you sign it for me.
There you go. It'll be worth even less then. Anyway.
Or I'm the only one with the signed copy, or actually a copy.
Go.
No, I'm just giving you a hard time. I remember thinking that was a pretty good read, by the way.
Well, thank you.
So anyway, it's so good to have you on. I really appreciate you joining us today, and we'll have you on again soon. And again, I just think that once we get a little bit of clarity. I think it'll be easier for people to plan. But usually when there's not clarity, that's where you make the hay, right, Andy?
Exactly. Those are the opportunities.
Yeah. All right. Well, hey, great to have you on, and we'll chat again soon.
All right, my friend. Take care.
All right. Big thanks to Andrew Busch, former Chief Markets Intelligence Officer at the Commodities Futures Trading Commission. And check out his website. He's an economist at andrewbusch.com. And again, that's Andrew Busch, BUSCH.com. AndrewBusch.com. Check out his website. And as always, hey, be sure to subscribe, follow, leave us a 5-star review on Apple Podcasts. And as always, subscribe and turn on those notifications so you know when a new episode drops. We are back on Tuesday, and I look forward to seeing you then.
A News Radio WBBM podcast powered by Odyssey.